Ever caught yourself pondering over the Ponzi scheme tax deduction? Perhaps you've heard about it, but aren't sure what it means or how to use it. Well, you're in the right place. The Ponzi scheme tax deduction, or more formally known as the theft loss deduction, is a handy tool for financial advisors. It allows victims of fraudulent investment schemes like a Ponzi scheme to recover some of their losses through their tax returns. Imagine your client invested a hefty sum into a business opportunity that turned out to be a scam. They've lost their investment, and they're understandably upset. Now, imagine being able to tell them that they can recoup some of those losses when tax season rolls around. That's the power of the Ponzi scheme tax deduction. It's a silver lining in an otherwise unfortunate situation. Now that we have a basic understanding, let's delve deeper into the process. First things first, not everyone can benefit from this tax deduction. So who exactly is eligible? Well, the Ponzi scheme tax deduction is designed to provide relief for victims of fraudulent investment schemes. It's named after Charles Ponzi, who notoriously conned investors back in the early 20th century. Today, this tax deduction is a lifeline for those who have lost money in similar schemes. To be eligible for this deduction, you must have suffered a financial loss due to fraud. This could be in the form of a Ponzi scheme or another fraudulent investment operation. The loss must be a direct result of the fraud, not merely a poor investment decision or a downturn in the market. The Internal Revenue Service, or IRS, considers several factors when determining eligibility. One of these is the nature of the loss. Was it a theft loss? Meaning, was the loss due to a fraudulent taking of property? The property must have been taken with the intent to deprive the owner of their rights. The second factor is the year of the loss. The IRS requires that the loss be claimed in the year the fraud was discovered, not necessarily the year the investment was made. So if you invested in a scheme in 2020, but only discovered the fraud in 2024, you would claim the loss for the latter year. The third factor is the status of the investor. This deduction can apply to both individuals and businesses. However, the IRS stipulates that the investor must have a legitimate expectation of profit from the investment. This means the deduction wouldn't apply if the investment was made as a gift or donation. Finally, the investor must be able to prove the loss. This typically involves providing documentation of the investment and the fraud, such as bank records, correspondence with the fraudster, and legal documents. Now that we know who can use this deduction, what are the steps to actually use it? The process might seem daunting, but it's actually quite straightforward once you understand the steps. Let's break it down. The first step to using the Ponzi scheme tax deduction is recognizing the loss. This is a crucial step because until you acknowledge the loss, you cannot claim it. In the context of a Ponzi scheme, this means acknowledging that you've invested in a fraudulent operation and have lost money as a result. Once you've recognized the loss, you need to calculate it. This might sound simple, but it can get a bit complex. Here's why. The Internal Revenue Service, or IRS, allows you to deduct the qualified loss, which is the amount you invested minus any money you've already recovered and any expected recoveries. So you'll need to subtract any recovered funds and potential recoveries from your initial investment to find out your qualified loss. Next, you'll need to report the loss. This is done on your federal income tax return. Specifically, you'll report it as a theft loss, which falls under the category of casualty and theft losses on Schedule A, itemized deductions. A key point here is that the loss is not subject to the usual limitations on theft losses. It's considered a fully deductible loss, which is a significant benefit. After you've reported the loss, you'll need to substantiate it. This means you'll need to provide evidence to the IRS to prove your loss. You can use various documents for this, such as investment records, correspondence with the fraudulent investment operation, or legal documents related to the scheme. The final step is to be patient. The IRS review process can take time, especially for something as complex as a Ponzi scheme tax deduction. But remember, you've done all you can at this point. It's now in the hands of the IRS. Now, let's talk about why each step is important. Recognizing the loss is essential because it's the first step in claiming the deduction. Calculating the loss is necessary to determine the amount you can deduct. Reporting the loss is how you officially claim the deduction, and substantiating the loss is necessary to prove your claim to the IRS. Finally, being patient is important because the process can take time. So to recap, recognize the loss, calculate it, report it, substantiate it, and then be patient. These are the steps to using the Ponzi scheme tax deduction. They might seem daunting, but once you understand them, they're quite straightforward. And remember, each step is as important as the next. They all work together to help you claim the Ponzi scheme tax deduction. Subscribe and leave a comment below if you like these type of videos. Let me know if you recently discovered if you or someone you know has been scammed.